All right, let's get straight to it. The U.S. markets are closed for Friday, October 31st, 2025. Plug Power, ticker PLU, finished the official session at $2.69 a share, up about 1.5% on the day. In the after-hours market, it ticked down slightly, sitting around $2.67. Now, the common expectation when looking at a chart like this, a stock that has been absolutely decimated from its highs, is that this has to be the bottom. The narrative you'll hear is that the green hydrogen future is inevitable, and that a massive, game-changing $1.66 billion loan guarantee from the Department of Energy, which was announced earlier this year, has de-risked the entire company. The reality, however, is that the stock is $2.69. That $1.66 billion loan was announced back in January, and instead of rocketing to the moon, the stock is trading near its 52-week low. This price isn't reflecting a coiled spring, it's reflecting a profound crisis of faith. The market isn't questioning the hydrogen story, it's questioning Plug's ability to execute and, more importantly, its ability to stop burning cash at a terrifying rate. The biggest news in the company's history has, so far, failed to change the one thing that matters: the company's deeply negative margins. Most investors looking at Plug Power are doing so with a story in their head. They see the global push for decarbonization. They look at Tesla stock and wish they had bought it a decade ago. They see the artificial intelligence boom driving NVIDIA stock and are searching for the next big secular trend. Green hydrogen is one of those trends. The expectation is that Plug, with its end-to-end ecosystem strategy, is the one to own. So people open their Robinhood app or their Fidelity mobile app, see a stock for under $3, and think it's a no-brainer. They buy a few fractional shares or maybe even a large position for their Fidelity IRA, believing they are getting in on the ground floor. This is the expectation: a cheap entry into the next great American industry, now backed by the full faith and credit of the U.S. government. But here is the challenge to that thinking, the reality that the chart is screaming. That DOE loan isn't a blank check. It's a loan guarantee to help finance the construction of up to 6 new hydrogen production plants. That's capital expenditure. It doesn't fix the core underlying business. And what is that underlying business? According to their last quarterly report from Q1 of this year, it's a business with a gross margin of negative 55%. This is the central, terrifying fact. For every dollar of product they sold, it cost them roughly $1.55 to make and deliver it. You cannot build a sustainable enterprise on those numbers. This is why the recent stock movement has been so bleak. Despite the DOE loan news, the stock has been trapped. If you pull up a chart on your Fidelity trading platform or Interactive Brokers platform, you'll see the 52-week range is between 69 cents and $4.58. We are much, much closer to the low than the high. This isn't a dip, it's a prolonged state of distress. The trading volume has been telling. On days with negative market sentiment or bad news for the clean tech sector, the selling volume on Plug is substantial. On days like today, where it's up a cent or two, the volume is often anemic. This pattern suggests distribution, where long-term frustrated holders are using any small bit of strength to get out, rather than accumulation, where new buyers are aggressively building positions. The smart money, the large institutions that use sophisticated Fidelity Wealth Management or Schwab Intelligent Portfolios, are largely on the sidelines. Analyst ratings, which you can check on most investing sites, are overwhelmingly a hold. This isn't a buy or a sell. It's a "we don't know." The price targets are all over the map, with many analysts having targets below the current trading price, indicating they see more pain ahead before any gain. The core of this disconnect, the tension between the multi-billion-dollar expectation and the $2.69 reality, is the balance sheet. In that same Q1 2025 report, Plug reported using $152.1 million in cash for its operating activities. They ended the quarter with about $295.8 million in unrestricted cash. At that burn rate, the math is simple and brutal. The company was on a path to run out of cash. This is why they took on a new credit facility and, more importantly, why the DOE loan was a must-have. But the market has done the math. The loan is for building new plants. It doesn't fix the negative 55% gross margin. What investors are terrified of is that Plug will spend the next 2 years building these beautiful government-backed facilities only to produce hydrogen from them at a loss. This macro environment, with persistently high interest rates, is the worst possible one for a company like this. When capital is expensive, investors flee from story stocks and jam tomorrow promises. They want profits today. They sell their speculative SoFi stocks and buy Apple stock or Fidelity mutual funds that track the S&P 500. This is the macro headwind that Plug simply cannot escape. This is the central problem, and it's a tough one for anyone doing self-investing. It's a binary bet. I want to know what you think. Comment below. Do you believe the $1.66 billion DOE loan is the ultimate lifeline, or is it just delaying an inevitable cash crunch? It's the single most important question for this stock. This is not a simple investment decision. It's a highly speculative gamble on a complete operational turnaround. For those new to the story, here's what Plug Power actually does. Their business was built on material handling, specifically hydrogen fuel cells for forklifts. Their big customers are Amazon and Walmart. This is a solid idea. A hydrogen forklift can be refueled in minutes, whereas a battery-powered one takes hours to charge. That's real value in a 24/7 logistics center. This was the reality that provided the revenue. But the expectation is what they call the green hydrogen ecosystem. This is where they try to do everything. They manufacture the electrolyzers that create hydrogen. They are building the plants, like the new one in Georgia and the ones planned in Texas and New York, to produce the green hydrogen. They have a logistics network to deliver the hydrogen. And they sell the fuel cells that use the hydrogen. This vertical integration is the bull case. The bear case is that they are trying to do too much, too fast in an industry that's not fully formed. They also have serious competition. Companies like Bloom Energy are also in the space, and their financial metrics, like return on invested capital, are worlds better than Plug's, which are deeply negative. So, where does this leave us? Let's look at the future outlook. The bear case, the reality side, is simple. The cash burn continues. Their Project Quantum Leap, a cost-saving initiative, fails to move the needle. The gross margins remain stubbornly negative. In this scenario, the $1.66 billion DOE loan is spent, the new plants are built, and the company still loses money on every kilo of hydrogen it sells. If this happens, they will have to raise capital again, most likely through a massively dilutive stock offering. Selling hundreds of millions of new shares at $2 or $3 would crush existing shareholders. This is the nightmare scenario that the current stock price is flirting with. This is the risk you take when you look for investment help and someone points you to a speculative name. The bull case, the expectation side, is equally stark. It all comes down to the next few earnings reports. The company must show a clear, undeniable, and rapid path to positive gross margins. The narrative about the Georgia plant coming online and improving efficiency has to show up in the numbers. We don't want to hear less negative. The market needs to see positive. If Plug Power can post a quarter where they demonstrate that their core business, especially the new hydrogen production, is actually profitable, this stock will not be at $2.69. A positive gross margin would validate the entire business model and prove the bears wrong. That is the only catalyst that truly matters. Anyone doing online investing can set alerts on their Sophie trading platform or individual brokerage account for the next earnings date. That is the day of reckoning. This is a stock that could easily double or get cut in half on a single earnings print. In the end, Plug Power at $2.69 is the ultimate story of expectation versus reality. The expectation is a vertically integrated, government-backed green energy giant that will power the future of logistics and heavy industry. This is the story people buy on Robinhood stock trading or Sophie investing. The reality is a company that is burning through cash with a core business model that, to date, has been fundamentally unprofitable, losing 55 cents on the